Hello teacher, we are group 1 from class IBC02. Welcome to our group presentation. Today, we will present the financial analysis of Sông Hồng Garment Joint Stock Company, which is one of the biggest garment manufacturers in Vietnam. And our group includes 5 members: Hồng Đức, Lê Huyền, Gia Huy, Hoài An, and me is Thanh Hằng. And our presentation is divided into 4 parts. I'll start with a brief introduction about the company. Then my friends will continue to contribute to the other part of the report. And about introduction, let me start with some general information about its history. Sông Hồng Garment Joint Stock Company was established in 1988 under the name of 17 Garment Factory, directly under the state with more than 100 workers. However, in 2004, the company was equitized and operated as a joint stock company with the charter capital of 12 billion Vietnamese dong. At the end of 2018, the company was officially listed on the wholesale stock exchange with a charter capital of 476 billion Vietnamese dong, and its ticker symbol is MSH. After more than 30 years of operation and development, Sông Hồng Garment has always been one of the leading manufacturers in Vietnam textile and apparel industry with 9,561 workers. And Sông Hồng Garment Joint Stock Company is currently operating in the textile and apparel industry with two main business lines. They include producing apparel for export and producing blankets, sheets, pillows, and mattresses for domestic consumption. Up to now, Sông Hồng has been a prestigious manufacturer of many famous fashion brands thanks to its outstanding production capacity. And about its capacity, they are able to produce 150,000 yards per month bedding products and 40 million garments per month. As I researched, they have now 144 sewing lines, sheet garment and bedding production areas in Nam province. And in each garment factory, it has 8 sewing lines and with about 500 workers. Their main export markets are US, EU, and Japan. In terms of their typical customer, they include Columbia Sportswear, Zara, Macy's, Costco, Walmart, The Children's Place, Forever 21, Porsche, and Bershka. And based on the BIDV security firm's finding, we can see that MSH profit margin is extremely higher than most of its competitors, except for GDP. However, its GPM exceeds the industry GPM for a relative large proportion. From this point, we can assume that MSH company has become one of the leading enterprises in Vietnamese textiles and garment industries. And in terms of its audit firm, in 2018, Sông Hồng Garment Joint Stock Company audit firm was BACO Auditing Company Limited. However, in the last 3 years, from 2019 to now, they signed an auditing contract with Grant Thornton Vietnam Limited to audit its financial statements. And on January 22nd, 2019, the board of directors of the company decided to establish a subsidiary in Hưng with charter capital of 150 billion Vietnamese dong, and the ownership rate is 51%, equivalent to 76.5 billion Vietnamese dong. Its headquarters now is on the number 105 Nguyễn Đức Street, Thống Nhất World, Nam Định City, and you can access to its website www.songhom.vn for more information. And the last information I wanna provide to you is its member of BOD. There are 7 members of BOD in the company. First is Mr. Bùi Đức Thịnh. He is a chairman of BOD who hold most shares of ownership, which accounts for 23.91%. Second is Mr. Bùi. He is the son of Mr. Bùi. He is also the second largest shareholder in the company. The remaining 5 people are Mr. Nguyễn Tường, Mrs. Lê Thị Hồng, Mr. MSH, Mr. Đinh Trần Thi, and Mrs. Nguyễn Thị Hạnh. She is also the last member of BOD in 2021. And to know more about the financial health of the company, the next part we will analyze its financial report.
Hello teacher, I'm Gia Huy. My part here is about analysis of balance sheet. Alright, here we can see here, these are balance sheet and composite balance sheets of some home company. I know it's kind of hard to see here, so let's break the table into sections and analyze each of them. The first, total current asset, many factors here, so but let's focus first the cash and short-term investment and total inventories. It accounts for a fairly high proportion, respectively average 42% and more than 33%. And the good short-term investment usually offer high liquidities, meaning that the company can access the cash invested in it quickly. However, heavy inventories account for a relatively large share can be difficult for the companies, but the number is decreasing positively year by year. And the next, we got total asset, and the rest of total asset, as we can see here, is the non-current asset, which accounts for about more than 26% on average. And next is the total current liabilities. This is a chart and it is a table, but we focus on these 4 main factors. The first, accounts payable. Some homes have stable account payable, but highly accrues expenses reduce the company current cash flow need, but increase effectively to create liabilities that will become due in the future. Short-term debt fell dramatically in just 1 year, although it's also larger than the company cost and cost equivalents. It still suggests that the companies managed to pay off its impending obligation. Capital lease, the last, account for a fairly large proportion of nearly 40%. Next, we got total liability. So like total asset, the rest of total liabilities is non-current liabilities, which accounts for about 4 to 6% on average. And the last, we got total stockholder equities. We got retained earning accounts for a very large amount and steadily growing from 3 years. And more companies with a healthy retained earning will try to strike the right combination of making shareholders happy while also financing business growth. But at the same time, throughout 3 years, total common stock and other chapter capitals have declined steadily. This is not ideal, since this is maybe less possibilities for the long-term profits. So what caused this fluctuation? The first reason we might think that it is COVID-19, right? So a significant deterioration in the operation result and financial position of companies because of the COVID-19 outbreak can cause a decline in accounting for financial assets and liabilities. And the net result is company action. We think the declines in all some home liabilities come from the fact that the companies had limited debt insurance due to concern about difficulties of meeting solvencies. And last, is planning to increase in financial assets. We assume that to compensate for the decrease from total liabilities, some home has tried to be more financially self-sufficient. And that part, we will compare some home with portray government BTGs and nhà bè government MNB. Here is the total current asset, the chart. So in terms of cash and cash equivalent, both some home and BTGs decreased during the year from 2018 to 2020 first line. Although nhà bè fell in 2019, net year is grew. Moreover, short-term investment of nhà bè are quite surprising when compared with some home and BTG, because it's always make up a small amount. smaller than 3% of the company's total current asset. And that we see that all three companies have a decreasing proportion of short-term receivables over the 3 years. And we note that although are larger than cash, so when the companies have high levels of receivable in relation to its cash on hand, it often indicates less business profit in collecting the debt. So in terms of inventories, it can be seen that all three companies try to gradually reduce the numbers of inventories over the year, because all of those account for a huge amount of total current asset. It would be better if company tried to solve the problem. And then we got the total asset. So we see that Sông Hồng fixed asset represent over more than 19% of total non-current asset on average. And BGD fixed asset have the smaller amount, we can see here. And then we will come to total liabilities, includes current liabilities and non-current liabilities. So in terms of short-term liabilities, all three have a large share of total liabilities. Moreover, the accounts are still smaller than the company cash and cash equivalents. So this suggests that all three may be in good financial health and may have enough cash to pay off their impending obligation. And finally, we got the total stockholder equities. So in terms of total common stock, all three have the relative same amount. But while BDGs decrease and then increase, Nhà Bè gradually increase, Sông Hồng gradually decrease over the year from 2018 to 2020. But when it comes to retained earnings, however, we can observe that Bình Dương retained earnings are reduced year by year, while Sông Hồng has increased. And the decrease in retained earnings doesn't necessarily mean a bad thing. It's possible that the company focused on investment that will right futures return of investment or growth would lead to a lot for the year. So in conclusion, it can be seen that Sông Hồng had a healthier balance sheet than Bình Dương and Nhà Bè of a positive net asset position. Like we got the stable asset elements such as low inventories and more debtors than Creator. However, for a more balanced conclusion, we should consider the other balance sheet determinant like the ratios in the next section.
Thank you, Huy, for such an amazing presentation. Now, for my part, I will analyze the Sông Hồng government income statement for you. First, we're talking about the total operating revenues. In general, the sudden and rapid outbreak of the COVID-19 pandemic since the end of 2019 had caused a far-reaching effects on the entire garment industry in general and Sông Hồng garment sale in particular. At the end of 2020, Sông Hồng Garment, its joint stock company, recorded 3,950.8 billion in net revenue and 751 billion in gross profits, down 13.46% and 19.11% respectively compared to 2019. Cost of goods sold were also recorded at 3,062.3 billion dong, down 12.07% compared to previous year, which is counted for 80% of revenue structure. As we can see from the table, there was steady growth in the total operating revenues from 2018 to 2019, increased by 12%, which is 460,426.04. However, according to the 2020 financial report, total operating revenue has shown a slight decline, fell by 40%. This drop may come from the unstable financial situation caused by the global COVID-19 epidemics. Due to disease, the demand of goods is reduced, and the supply chain are disrupted, making it difficult to export goods overseas. Next part, we're talking about the total cost of goods sold and total expense. From the table above, we can clearly see that from 2018 to 2019, Sông Hồng government had made some cutting cost decisions to increase profits, with 12% raise in total operating revenue. Total cost of goods sold also decreased by 10%. Also increased by 10% in 2019, but compared to total cost of goods sold in 2018, it only accounted for 49% of total operating revenue, which decreased by 1%. Same with total expense, it's increased in 2019, but decreased 1% in the common side income statement. As we talked before, due to the pandemic lockdown, the firm couldn't produce and sell as much as before, but they still have to pay salary for employee, interest to the bank, and renting free. Therefore, the total expense of 2020 accounted for 93% of total operating revenues. When comparing total cost of goods sold of Sông Hồng Garment to other competitors in the garment industry, we can clearly point out that Sông Hồng Garment had the lowest total cost of goods sold among the three, which only accounted for around 80% of total operating revenues. It implies that for every 1 million revenue, Sông Hồng Garment can get 200,000 đồng gross profits, while for Bình Dương Garment, it's only range from 150,000 đồng to 170,000 đồng, and for Nhà Bè Garment, it's 180,000 đồng to 200,000 đồng gross profits. We can conclude that Sông Hồng Garment were good at maintaining a stable percentage of total cost of goods sold for the past 3 years, despite the pandemic affliction. From the column chart above, the total expense before income tax in 2020 of Sông Hồng Garment and Nhà Bè Garment are much higher than previous year. This sudden increase in total expense is largely due to the instability of the economy during the pandemic. Because one of the firm's objective is to cut down on the percentage total expense over the year. We can see from 2018 to 2019, the total expense of Sông Hồng Garment and Nhà Bè Garment had decreased by 1 to 2%. However, Bình Dương Garment has not managed well the financial situation of the firm when the revenue achieved is not commensurate with the total expense that the company had to pay. Bình Dương Garment not only had the lowest total revenue but also had the highest percentage of total cost of goods sold and total expense among three companies. Next, we're talking about the total operating on extraordinary gain and loss. So what is non-operating gain and loss? It refers to the income that not attributable to a company core value operation. For example, investment, foreign trade, exchange, and sale of asset. Only in 2018, Sông Hồng Garment experienced non-operating loss, which is 445.42 million VND. From 2019 to 2020, company gained nearly 0.02% of total operating revenue from non-operating activities. Finally, I will introduce to you the earning per share of Sông Hồng Garment and compare it with other competitors. Earning per share of Sông Hồng Garment in 2018 reached at 10,232 per share, increased 80% compared to 2017, along with a listed price on hold of 45,000 đồng per share with a price fluctuation 20% in the first section. However, in the past 2 years, we have continuously see a decrease in earning per share of Sông Hồng Garment, namely at a decrease of 10% in 2019 and decrease of 49% at the end of 2020. From that, we can point out that the value of Sông Hồng Garment share is decreasing attractiveness to stock buyer. The company should apply new policy to attract investment in the upcoming year. The above comparison table clearly shows that earnings per share of all three companies reached the highest value in 2018 and gradually decreased in the next 2 years. The signing of Vietnam EU Free Trade Agreement (EVFTA) in 2018 had helped the garment industry develop well. In 2020, due to the impact of the pandemic on the global economy, the income of investors also decreased. They limited investment in companies that bring little profits. In particular, of the three companies, earnings per share of Sông Hồng Garment had the strongest decline, whilst Nhà Bè Garment earnings per share had a slight growth. And that's the end of my presentation. Now I move the mic to other members of my group. Thank you.
Hello teacher, my name is Hoài An. I and Hồng Đức will be responsible for the section 3 ratio analysis. The first ratio would be analyzed is the liquidity ratio. As you can see on the screen of Sông Hồng Garment liquidity ratio, the current ratio and quick ratio over 3 years constantly increased and were greater than 1. Especially in 2018, you can notice that the quick ratio was lower than 1, while the current ratio was 1.26. This means that the company could be relying on inventories to meet its short-term liabilities. And to analyze the cash ratio, in the first 2 years, cash ratio slightly increased and then dropped in 2020. The ratio were all less than 1 over 3 years. This means that cash on hand were insufficient to cover current liabilities. When comparing with competitors, you can notice on the graph that in the first 2 years, Sông Hồng Garment did not pay debt obligations as well as Bình Dương Garment. However, in 2020, Sông Hồng Garment surpassed both the two competitors by the increasing in the current ratio and quick ratio. Regarding the cash ratio from 2018 to 2020, we can see that although there was some shift in position between three companies, Bình Dương Government has the highest and most stable ratio. It exceeded both Sông Hồng Government and Nhà Bè Government quite far. And from the analyzing process, we also noticed that Sông Hồng Government's liquidity ratio is higher than the industry average. So we can conclude that Sông Hồng Government has a more significant margin of safety with regard to the ability to pay up debt obligation than other businesses in the textile industry. And that's it all about the liquidity ratio. Now we will come to the efficiency ratio, the second part of the ratio analysis. I will start with the inventory turnover. As illustrated, inventory of Sông Hồng Government was most efficiently managed in 2019 with the highest inventory turnover and the lowest number of days sales in inventory over 3 years. When comparing with competitors, as shown on the graph, Bình Dương Government handled inventory more efficiently in the first 2 years. Obviously, it took Bình Dương Government only around 50 days to convert inventory into sales, while inventories of Sông Hồng Government had to sit on the shelves for the next 20 days before being turned into cash, facing a high risk of theft and obsolescence. However, in 2020, Sông Hồng Government overtook the other two competitors in managing inventories. And the second efficiency ratio is the receivable turnover. In 3 years, it took Sông Hồng Government from 1 to 1.5 months to collect receivable from customers, and the collection occurred every 8 to 12 times a year. 2019 seemed to be the year that Sông Hồng Government was most efficient in collecting receivable, with the highest receivable turnover and the shortest day sales in receivable. When comparing with competitors, the efficiency level of Sông Hồng Government and Bình Dương Government in collecting receivable from customers was relatively similar, while Nhà Bè Government took quite a long time to receive their cash from customers. Is it something in caution? I will move my face to here so that you can clearly see the slide. And the last efficiency ratio is the total asset turnover. In 3 years, the total asset turnover of Sông Hồng Government was greater than 1. This means that the net sale of the company was greater than the average total assets, and the total asset turnover was highest in 2019, then slightly decreased in 2020, and maybe the sale dropped due to the impact of COVID-19. And when comparing with competitors from 2018 to 2020, Bình Dương Government seemed to manage their assets better than Sông Hồng Government, being improved by a higher total asset turnover, and Nhà Bè Government were the least efficient in generating assets into sales. The next part is long-term solvency ratio. The first long-term solvency is the total debt ratio. The total debt ratio of Sông Hồng Government was decreasing over time, as you can see on the graph. This means that the company was maintaining a lower proportion of debt and can be considered to be less risky. When comparing with the other two competitors, the difference between Bình Dương and Sông Hồng Government total debt ratio was not very large. In 2018 and 2019, Bình Dương Government total debt ratio was better than those of Sông Hồng Government. However, in 2020, Sông Hồng Government surpassed both Bình Dương Government and Nhà Bè Government in managing debt. And the second is debt equity ratio. Over 3 years, the company total liability dropped and total equity expanded, causing the debt ratio to go down, showing a good signal that more and more investors were investing in Sông Hồng Government. When comparing with competitors, regarding Bình Dương Government, in the first 2 years, Sông Hồng Government was surpassed by Bình Dương Government as the competitor has lower debt to equity ratio. However, in 2020, Sông Hồng Government overtook its component by performing a lower debt equity ratio. Nhà Bè Government owes such a high debt level and should be in severe financial trouble if the company did not have any further strategy. And that's it all about my presentation. Please welcome Đức to present the last part of our assignment.
Hi, I'm Đức and I'm going to continue my presentation about long-term solvency ratio. Now we're going to talk about the equity multiplier. Here's the table for MSH ratios. We can see that they were decreasing over the years. It means that MSH was paying off the debts, they were reducing the financial leverages. And in comparison with the other competitors, we can come to this conclusion in 2018, in 2019, and 2020. And in comparison with the industry average, except for the ratio in 2018, the following years, the ratio of equity multiplier stayed below the industry average. So this indicates that the company had good asset capital structure. They have a very low debt ratio. Continue, we go to times interest earned and the cash coverage. Here's the table. We can see that an increase of 10.91 occurred in 2018 to 2019. This is due to the revenue increased and the interest expenses decreased. The following year, we see a decline of 5.57. This is due to the revenue decrease while the costs of SA&D were rising. Similarly, we have the cash coverage. This ratio uses EBITDA instead of EBIT, like time interest earned. So we can also observe the same phenomenon, a large increase followed by a slight decrease. In comparison with the other competitors, we can come to this conclusion. And while the BDG had much more high ratios and had redundant money to pay for the interest expenses, and the MNB was struggling to pay for the interest expenses, MSH stayed in between, and they stayed well above the industry average. So what does this mean? It means that the overall MSH didn't have any problems of paying interest expenses. And finally, for the conclusion for long-term solvency, we see that low financial leverage and the equity multiplier is decreasing. High TIE and the cash coverage ratio, very high relative to the industry. So they have good financial health and they didn't face any problems in terms of long-term solvency. Next, we have the profitability ratio, and gross profit margin is first. We observe a fluctuation, an increase followed by a decline. This is mainly due to the fluctuation of the revenue. When compared with the competitors, we see that in the 3-year period, MSH stayed at the first place. And in addition, all the values were greater than the industry average. And so this strongly indicates that MSH had a cost-effective production and a good pricing in the industry. When it comes to the profit margin, we also observe a fluctuation in the profit margin. This is due to the net revenue, and in the end of 2020, we also observed the reason of the SA&D costs. When compared with the competitors, the figure is now different from the gross profit margin due to the high SA&D costs. And so in 2019 to 2020, MSH has lost its first place to BDG. However, the values were greater than the industry average, and we still consider that MSH had a good profit margin. Return on average assets. In this ratio, we're going to use the DuPont analysis to analyze the ratio. And when the PM and the TAT increased in 2018 to 2019, we see an increase in the ROA, and vice versa. When both the PM and the TAT decreased, we see a major decline. Compared with the competitors and the industry average, in 2019, MSH was performing well and they were growing, but not in the other 2 years, especially in 2020 when COVID hit. However, all the values were still greater than the industry average at a fine margin, so we still consider them profitable, at least in the industry. And lastly, we have the return on average equity. We also use the DuPont analysis, and remember that the equity multiplier of MSH, as I mentioned earlier, they were decreasing. And so in the first period, even though our increased, it still increased at a pace less than the equity multiplier. Of course, that led to a decrease. And when ROA and A&E both decreased, we see a major decline of 24.61%. Comparing with the competitors and the industry average, we see the same conclusions at the ROA. However, when it comes to the industry average, 2020 ratio was lower than the 5-year average. So the MSH profitability was at a high rate in 2019, but then when it took a hit in 2020, MSH is still considered more profitable than the industry at least. Conclusion. 2018 and 2019, the ratios were high, they were growing, but when the COVID-19 pandemic occurred, the ratio plummeted due to the declining revenue and the high S&AD costs. Overall, we can see the profitability. However, they are struggling to generate sales and control S&AD costs, and we hope to see the recovery from this. And the last group is the market value ratio. And first, we're going to start with the price to earning ratio. The PE uses the net income ratio. So when the net income increased, we see a decrease and vice versa. Comparing in the 3-year period, MSH stayed in the second place, or the values were lower than the industry average. And so we can conclude that the MSH was getting less cheap after 3 years. However, it is still considered cheaper than the industry average as a whole. Moving on, we have the price to book ratio. Now, the market price for MSH was falling, while the book value per share was increasing. So in the numbers, we can observe a steady decline from 2.09 to 1.38 after 3 years. When comparing in the first 2 years, MSH had the highest ratio, but in the end of 2020, MSH quickly dropped to third place. All the values were lower than the industry average except in 2018, and so we can actually feel that the market was reducing the expectation, the speculation for the stocks, and now the stock were valued less than the competitors in the industry. Lastly, we have the EV over EBITDA ratio, and in the name we actually see the calculation. So we can have the conclusion: when the EBITDA greatly increased, we see a drop, and when the EBITDA greatly decreased, we see an increase in the ratio. In the perspective with the competitors, the first 2 years MSH stayed in second place, but in the 10 to 20 it quickly rise to 8.2. All the values were lower than the industry, and so for the amount of EBITDA it was generated, MSH value was getting higher and higher. However, in the industry perspective, the MSH was undervalued. So conclusion, all of the three ratios were lower than the industry average, while other performance like liquidity, solvency, and profitability ratio were pretty great. And so MSH in the 3 year was undervalued by the market. And the section 4, conclusion. For the liquidity of MSH, we rate it as the medium because the ratio were around the industry average. Efficiency was low. The long-term solvency was very good with the low debt ratio. Profitability was good, and the market value, the market was valued the MSH stock very low. And that is all for our presentation. Thank you for listening.